Imagine a ship sailing through treacherous waters, its compass spinning wildly as it navigates through a storm. That's what the current gold chart looks like, and it's signaling a potentially bearish setup for traders. Here's why that matters. With the breakdown below the 200 moving average in gold and the 66 to 64 zone in silver, we're seeing a significant shift in the market sentiment. The gold price, currently at $386.54, is hovering near its recent lows, and the silver price is also under pressure. Now consider this. The VIX, a measure of market volatility, is at 17.68, indicating that investors are getting nervous, and the dollar index at 99.59 is firming up as traders weigh the prospects of an Iran ceasefire. But there's a catch. The Fed's hawkish tone, with a target rate of 3.50%-3.75%, is not expected to change anytime soon, and the first cut is not expected until 2027 or later. This means that the market is likely to remain volatile, and traders need to be cautious. The current macro environment, with oil at $80.82 and the 10-year yield at 4.49%, is also adding to the complexity. Which brings us to the key question: what does this mean for gold and silver prices? The answer lies in the charts, where we're seeing a clear breakdown in the gold and silver prices, indicating a potential bearish trend. Now let's dive deeper into the numbers. The gold price has broken down below the 200 moving average, which is a significant technical indicator. This breakdown is a sign of weakness in the market, and it's likely to lead to further declines. The silver price, on the other hand, is struggling to stay above the 66 to 64 zone, which is a critical support level. If silver breaks down below this level, it could lead to a sharp decline in the price. For example, if we look at a well-known stock like Tesla, a breakdown below a key support level can lead to a significant decline in the stock price. We're seeing a similar pattern in gold and silver, where a breakdown below key support levels is leading to a decline in prices. And that's exactly the problem. The market is not just reacting to the current news, but it's also pricing in future expectations. The Iran peace deal hopes, the SpaceX IPO, and the AI revolution trade are all contributing to the market's volatility. But what's driving the gold and silver prices is the underlying sentiment, which is turning bearish. The weight of evidence is on the side of the bears, with the technical indicators, the macro environment, and the market sentiment all pointing to a potentially bearish setup. Now, some might argue that the gold and silver prices are due for a bounce, given the recent declines, but the charts are not indicating a clear reversal. The bulls might say that the market is overreacting to the current news, and that the gold and silver prices will eventually recover, but the bears would counter that the market is simply pricing in the reality of the situation. What this means for your money is that traders need to be cautious and disciplined in their approach. A disciplined desk would look to short gold and silver, or at least reduce their long positions, given the bearish setup. For example, a trader might consider selling gold at $390, with a stop loss at $405, and a take profit at $370. This would be a general, illustrative example and not a specific trade recommendation. The key is to stay focused on the charts and to adjust your strategy according to the market's changing sentiment. As we monitor the market's moves in our Discord, we'll be discussing the best ways to navigate this volatile environment. In conclusion, the current gold chart is signaling a potentially bearish setup, and traders need to be aware of the risks. The breakdown below the 200 moving average in gold and the 66 to 64 zone in silver is a clear indication of a bearish trend, and the market sentiment is turning bearish. As we move forward, it's essential to stay disciplined and focused on the charts, and to adjust our strategy according to the market's changing sentiment. Join us in our Discord, where we'll be discussing the latest market moves, and get ready to navigate the treacherous waters of the financial markets. Educational only, not financial advice.